We're going to be having our man Dan here covering calendar spreads part 2. He's going to give us a brief on the Delta Greek and how it functions within calendar spreads.
Today we're going to talk about so we're in the context of the put calendar spread structure, right? We're on part 2, and what we're going to talk about is the delta associated with a put calendar spread or a call calendar spread, because they both they're both going to work the same way. They're just the put calendar spread, as described in this presentation, is going to be situated below the spot price, and your call analog is going to be situated above spot price. In my kind of crude interactive delta graph example, I picked calls because I just love variety. And when we're talking about the put side, there are some more interesting implied volatility effects that will cover, I'm sure, in like part 3 and part 4, when we talk about implied volatility and vega inside put calendar spread. Today we're talking about delta. The hint of delta in this trade from my summary slide from last week is when I mentioned that out of the money calendar spreads like we're talking about here are positive gamma. When I say a put calendar has positive gamma, this positive gamma is implying that we are net long options. Even though we sold one and we bought one, the extra time that we have by buying the further dated option protects us from some of the nastier effects that are associated with having short options on your book. So the fact that these are positive gamma means that a directional move in your favor is going to increase the delta of your overall position more rapidly. So the interesting thing about about delta in the context of a put calendar is that when we're trading them in this out of the money fashion, the absolute value of the delta is going to grow and grow and grow until you get to the actual strike, until you get to the strike price. The one that you sold one and bought the other. So if price is moving in your direction and price finally gets there, that's where you're going to reach the maximum absolute value of delta. And I'm sorry to be bringing up math terms in this way, but technically delta is negative on puts, because in this particular structure the value is going to increase when price of the underlying goes down, right? So you have negative delta is what that means. And in favor of not being confusing math wise and saying something gets more negative, because that generally means like smaller, even though it's a good thing in this case, I just say the absolute value of the delta is going to continue to grow. Now, what's interesting about a calendar is that at a certain point, if price keeps on moving in your direction, maybe it moves a little too far in your direction, if you know what I mean, it goes past your strike, the delta can actually flip, and it can go from negative to positive. If it's on the call side, it can go from positive to negative. This doesn't. I promise you might hear that and think, well, it's going to blow up my position and it's going to go to negative whatever, and I'm going to lose a bunch of money. That's not how it goes. It's just the result of like both strikes being in the money, but the front one is closer to expiration, so that one is more likely to expire in the money. Has the absolute value of that short dated contract has now gotten larger than the back dated one. But long and short of it is that for most of the life of this trade, this put calendar spread, you're going to have negative deltas, and the absolute value of those negative deltas is going to increase as the underlying price moves in your direction. And that actually leads us into just a general review of delta. which I think is a good refresher for everybody every now and again. So the definition of delta is the change in an option's price, which is called premium, due to the change in the underlying security price. In equities, this is typically expressed as a decimal. Okay, so in your brokerage software, you'll see like something like 0.25 for a 0.25 delta call or put. But as you know, when you're like speaking about this, like when you're talking with somebody, it's not uncommon to hear them expressed as like the full whole number. So you might describe a 0.25 delta option as 25 delta. Just know that this very, very common, and it's the difference between like speaking and writing. I think it's a lot more common in writing to see 0.25 describing the delta, but in conversation, someone would probably describe it as 25 delta option. The standard equity multiplier for an option is 100. So we say ceteris paribus, which means everything else, all else equal. If the stock price like teleports in 0 seconds down $1, then a minus 0.25 delta put, right? I would call that like a 25 delta put, will see its premium increase by $25. Okay. You have a $1, minus $1 price change times minus 0.25, which is our delta, times a standard 100 equity multiplier for equity options, and that equals $25. And the intuitive way to talk about delta is in terms of like share equivalent, or what it what it feels like to own that number of shares. So the share equivalent of a 25 delta put, right, which is going to be negative, is going to feel like being short 25 shares of stock XYZ. Because if stock XYZ, if you were short 25 shares of stock XYZ and the price of XYZ went down by $1, your P&L, your profit and loss, would be plus $25. You would have unrealized gain of $25. And that's exactly ceteris paribus what would happen with a 25 delta put as well. If the price drops by $1, then the option value, the premium associated with that option would be $25 higher, because the price has moved $1 in your direction, and it was a 25 delta option. But when we talk about gamma, we'll know that, okay, now that the price has moved down, now it has a bigger delta value. So the next dollar move in your direction is going to be even larger, right? And that's that has to do with what we would say is convexity, and why long options, long calls, and long puts can have such a handsome reward profile when price moves in your direction very quickly. And so the one last thing that I just wanted to riff on briefly for delta is something that I hear now and again, and like some people would say that delta is the probability of the option in question expiring in the money. And I don't think that's actually I don't think that's true. Like if we were to do an empirical study and we were to look at all the 10 delta calls and the 10 delta puts, I suspect that those wouldn't finish in the money 10% of the time, right? Like I don't think I think that's a good heuristic when you're talking about the at the money call or the at the money put, because the at the money call or at the money put is typically around 50 delta, and that makes logical sense, right? You have an at the money contract. It's like 50-50, 50-50 chance, is the price going to go up 1 penny or down 1 penny, and you're and your option will finish in the money like by 1 penny or out of the money by 1 penny, right? Like that makes sense. If you think, if you're being a real first principles student of this stuff, the at the money delta of 50, that makes sense, right? There's like a 50-50 chance that option finishes in the money if it expires in the next 1 second or whatever like that. But towards the tails, right, at the extremes, I think that probability of finishing in the money, I think it's I'm not sure that necessarily would hold true, right? I think it's better to just focus on delta as like your underlying price payoff multiple for a given trade. You'll recall if you watched our review from last week, this slide was on here, and I wanted to show this slide again really quick here because it animates what the P&L difference is for a put calendar spread as time goes by. So when the trade starts, there's like a lower like tent kind of section here, and as time goes on, the profit will become potentially quite large right at the strike that you sold and bought over those different times. And so the last thing I want to touch on when I say that a calendar spread that's designed in this way has convexity, what I mean by delta convexity is that over time, as we get closer to expiration, moves in the underlying are going to have a more drastic delta change on a calendar spread. And so what you're looking at right here is my like a crude illustration of that. Be gentle. Be gentle. It's like I'm not a professional programmer by any stretch, right? So be easy on me here. And I chose this one. I know my consistency score I'm getting an F for consistency in this one because I'm talking about a call calendar in this image, and we've been presenting on put calendars before, but I chose the call calendar to hopefully avoid any confusion about negative deltas here. And I think once you see what I'm just gonna point out as time goes on is that this same like visualization makes sense for a put calendar as well. And really what this is just an expression you'll recall from our last slide. Okay, in this last slide, you saw how like over time this calendar like becomes closer and closer to a tent, right? And as you're approaching that strike and as time is going by, the P&L, right, the profit associated with this structure is getting bigger and bigger. And there's a reason for that, and it's this what I'm describing as delta convexity. Okay, so in this example here, right, I think I have this set. I think the calendar, like in this structure, it's like a 5825 SPX call calendar, which is out of the money by like, I don't know, like 2%, something like that, above spot price. Okay. And the way I had it set up is you're selling this upcoming Friday and you're buying the Monday after this, after that, right? So like the only thing in between these two is the weekend. And the way that these numbers here work, right, from left to right is like the number of days until this front contract expires. Okay. When you initially put the trade on, like on Tuesday, when I started building this, when I put this together on Tuesday, there were like 4 days until that front contract expired. And then at 300, that's like 3 days left, right? I did this as it's like a percentage of day remaining until the front option expires. Okay. So finally, to the point that I want to illustrate here. So if you put this trade on Tuesday, and then on Wednesday we get a real ripper in the S&P 500, and the S&P 500 like rallies up 2%. That's still great for this trade. This call calendar is going to appreciate in price pretty significantly, and you'll do pretty well, right? You'll make money on this trade. And the reason you'll make money is because your deltas are increasing, right? So if we if it's it is, yeah, okay, here's my like 3 days, right? It goes over time. And so over the day on Wednesday, your delta is increasing from, let's say, 0.025 to okay. It's increasing to like 0.4, at the maximum point here, it's 0.44, 0.41, right? It starts to, again, this is this like time effect that's taking place here, but you can see that the delta increases by 0.02 deltas. Okay, so we go from like 0.025 to 0.046 at the very highest, and that's if we get this excellent price appreciation on Wednesday because we bought it on Tuesday. Well, what happens if instead we actually get that price appreciation on Thursday? Okay. Well, on Thursday, our delta starts at approximately the same delta here. It's like a tiny bit higher because that front contract has collapsed in price more than the back contract has. So the delta is going to be just, the back contract has kept a tiny bit more long delta and the front contract has collapsed a fair amount, or has collapsed more because it's expiring sooner. So here we start from like 0.27, and if we get that same move up towards 5,800, oh wow, what a difference, right? Now it's at 0.08 delta. And so what I'm trying to convey here is that this price increase, like this 100-point SPX price increase, changes the delta on a call calendar on Thursday by like, I don't know, what is that, like 3x, something like that. Whereas on Tuesday, it kind of only doubled it, right? It only went up by 2x. So if you like get even closer to the wire, right? If you're riding even closer and you're letting it go and it's on Friday and that front contract is expiring today, and you get a nice rip up towards your 58.25 point up here, now we're really talking, right? This thing goes from 0.015 delta to 0.19. So at that point, that's more than 10x, right? That's like 15 or 14. That's like a 14x increase in deltas. And the price appreciation of this structure is going to be commensurate with its move in deltas, right? I said that back in my Mr. Nerd slide here, right? Delta is like that. There's like an inextricable connection between delta and premium associated with the net position of your contract, right? So when price moves in your direction as this front contract is getting closer and closer to expiration, smaller moves in the underlying equity generate a larger increase in the value of your overall position. And what I think is really kind of magical about that is that from a psychological perspective, it kind of makes these easier to hold on to, right? Because if price is steadily moving in your direction, if you just hold an outright out of the money call, and you just like wait and the underlying price reaches your strike by expiration, like you made a good prediction, but you didn't make any money. You lost money, right? Because like you had to pay for that call and price didn't get high enough, right? It's like over time, you're constantly chasing, like Like the value of the call, you're watching it psychologically and you were right in your prediction, but you're watching the value of your call, the premium on that call, like not go up when you were right. And the frustration, right? Like I can't, you don't have to tell me about that kind of frustration, right? It's aggravating to make a great forecast and then to have the trade actually lose money because your forecast was good, but price didn't go up enough or it didn't move up fast enough. Well, call calendars that are out of the money, if you're predicting a price increase, they do away with this problem. They're like the opposite of that. If price steadily moves in your direction, if you forecast a price increase and that like just perfectly graces its way up into that area, it's like the opposite of that effect, where you're just holding an outright call and you're watching it not appreciate, and you're cursing the market gods for giving you this forecasting gift and a position that's not making any money, right? The calendar trader is looking at his or her P&L and thinking, nice, right? Like this, the value of this is going up, commiserate with my forecasting skill. So to wrap up my delta section here with a little bow, what makes calendars unique and appealing is that your price prediction will pay off really well if the underlying kind of like cruises into the area where you're forecasting price to be, and you could see, right, it's that is demonstrably accurate because the delta on the net call calendar here becomes quite large as that front contract is expiring compared to when the trade starts. Like if SPX price just teleported up to 58.25, it'd be great. Your delta would increase, right? You would make some money on this trade, but if price just teleports up, you just want to own a call, or if it teleports down, you just want to own a put because you're going to get all the positive effects that are built into that in that scenario. But if price just kind of glides in one direction, if it kind of just chops up and down into this range, then your payoff is going to be really, really good. And again, like I will lean on this from a theoretical angle by saying, look at the growth of the delta. The delta change from like trade initiation at being, 0.02, 0.023, relatively low, to being 10 times higher than that at expiration of the front contract where you're predicting price is going to go. That's the conclusion of my delta section. If there are any questions, I'm happy to field them. And I am also working on a way to make this kind of visualization available, because I do think it helps kind of build up your intuition about how an option structure payoff is gonna work over time. So stay tuned. Hopefully we'll have something that helps express or that helps you see how this trade is gonna manifest on your P&L over time.
What effect, if any at all, does gamma have on these put calendar spreads?
So the gamma is actually what's like accelerating these deltas higher and higher as we march closer to the expiration of the front contract. So your net gamma on a put or a call calendar that's out of the money in this way is going to be positive, and it's going to move deltas it's going to move the net, right, the combined long and short deltas of the position in your favor faster and faster as we approach expiration. Like you're still going to be net positive gamma over here around like, day 0 and day 1 of your trade initiation. And you can see like there are like the leaps and bounds, so to speak, right? The delta increases, they're not really that fast as price moves up, right? From this like $10 SPX change gives you an increase of 0.03 deltas, which means like the gamma there is relatively small. And it even starts to slow down here as you get closer to the long short strike. Whereas when you get over here closer to expiration, okay, well now a $10 change from 57.30 to 57.40 changes the net delta of the position by 0.015, which I know doesn't seem like a ton, like we're talking about these tiny fractions and everything, but you got to remember SPX is a $5,700 product, right? So like one delta is like valuable, is a valuable thing to have on an SPX contract, right? You cherish every delta you get on when you're trading the SPX, because it's such a large product, right? So like, take a step back and remember, oh hey, I'm trading a $5,700 stock. So when it moves 2 deltas, that's pretty good.
So YKK asks, is it best to exercise the long position when it comes in the money? And what is the best situation to exit the strategy?
Okay. Yeah. Excellent questions. Okay. So in this particular example, with the SPX, I like the SPX is a cash settled product, and it's also a European style option. So you never have to worry about early assignment or anything like that, because it can't be, assignment doesn't happen until expiration, right? It's only allowed at expiration. So SPX is kind of a special case here. If you were dealing with like a single name equity or SPY, QQQ, something like that, generally speaking, you would want to exit at your strike price, right? That's like ideal place to exit. But I say that, and gosh, I hate to invite discretion into this sort of thing, but I would say you want to use your forecast as a guide, because with a calendar spread, if the underlying price just like rips right past your strike, there's a time where you're actually where you'll wind up with kind of a loser, right? Which can be annoying. That price moved too much, but like you can use your forecast as a guide, right? I like am almost cringing at hearing myself saying this, but like it's kind of a discretionary, it's kind of a discretionary decision. I would argue that in an ideal world, you want to always be able to trade at least 2, right? Like 2 units of calendars. So you would technically have 4 contracts, 2 spreads, and you would initiate the trade and get your fill. And like the first thing you could do is set a limit sell at maybe like 150% profit, right? Like the value of the spread has increased by say 150%, because that's not unreasonable or unachievable if price begins to move in your direction relatively quickly. As far as exercising the long, that's an excellent question, because in theory, if you were trading this on I don't know, one of these China names that just went ballistic, PDD. Okay, if you had a calendar on PDD at 110 and it rallied up to 150, well, now you're short a call that's $40 in the money, right? And you have assignment risk there, right? You're at risk of needing to, or rather, delivery risk, I guess technically. You're at risk of needing to deliver 100 shares of PDD, and the market price of those is 150, and you promise to deliver at 110, and that could be an unpleasant loss right there. What I suspect would happen, or at least what I hope would happen, is that if you happen to be away from your screens, and you have a calendar on, and you have one of these like PDD situations where the underlying price goes way past your strikes, my hope would be that your broker has the understanding, probably after communicating you with about this, that you don't want to be forced to deliver those shares. And so what would happen is that, should an early assignment come your way and you are obliged to deliver 100 shares of PDD, your broker would exercise the long call to give you those 100 shares, and have you deliver that way, right? So you don't have to. So the next day you don't wind up short 100 shares of PDD and dealing with the margin implications of that. So I would say, on a case where your strikes just get blown away and the underlying rallies far beyond where you had forecasted the price to move, you'd want to have your broker exercise the long leg to cover your obligation to deliver shares on the short leg.